Welcome to Bullshift, the podcast, where we talk about personal finance with a specific focus on optimism, bias, and the way the financial services industry shifts your attention to being more bullish. My name is John DeGuy. I'm the host of the podcast, and I'm also the author of the book, Bullshift. Welcome. My guest this week is Michael Konopaski. Mike is the co-founder and director of Designed Wealth Management, which is Canada's first dual-registered investment fund and mutual fund dealer. Mike has more than 25 years of experience in the investment industry, and he's built an investment dealer from scratch in the 1990s. He's a chartered professional accountant. He's a certified financial planner. He's a chartered investment manager. He has a master's degree and a PhD degree from one of the best personal finance and economics programs in the world. Michael, welcome.
Thanks, John, for having me. I've been looking forward to this.
Yeah, well, I've been looking forward to this too, because you're a bit of an iconoclastic person. You do a lot of things that sort of break the mold, and I love it when I come across people like this. I wanted to begin by talking about something that a lot of people might not really think of in the way they make decisions, and that's critical thinking. My sense is that the world is moving toward misinformation and disinformation at a dangerously alarming rate, and a lot of people seem incapable of ferreting the wheat from the chaff in terms of figuring out what's true and what isn't. And I wanted to begin by asking you about critical thinking in general, and maybe how that pertains to and how that compares and contrasts to mainstream thinking. What's your thinking about how other people are thinking?
Well, I'm a second generation in the business. My father was a stockbroker, and I grew up in an environment where he was a devil's advocate. So I learned from one of the best to look at different sides of situations, not to take things for granted. And really, I didn't realize it at the time, but that was my introduction as a kid, I guess, to critical thought and seeing things very differently from the mainstream.
And would you say, I wonder if you could offer your view then on typical investors in Canada and typical advisors in Canada in terms of where they might fit on that spectrum in terms of the ability to think critically and compare and contrast their views with those of others.
Well, critical thinking isn't taught in schools, really. I mean, if you're lucky enough to have a liberal arts background or education, I think that there's some really good programs that sort of introduce that to students. But really, it's something that people often have to pick up on their own. And in order to see all sides of a situation, you have to have some sense that what you're being told isn't true, or what you're being told isn't the full picture. And I was lucky enough in my scholarly work, and I was a professor at two different universities, and I stumbled across things like critical management studies and critical thought, and I was fascinated because that's always how I felt about things, but I'd never seen it with structure, and I've never seen it with theory until then. And it was very helpful to me because it gave me a platform, or like a scaffolding, to sort of have from my views, rather than just disagreeing with everybody all the time. And I'm sure you can understand it that.
I think that's one of the things that's interesting about the way you and I think, is that we are more inclined, without sounding too pompous, to think for ourselves rather than to simply accept what we've been told by bosses or what our peers say, and therefore accepting that must be right because that's what everyone else is doing. And I wonder do you think there's enough critical thinking in the financial services industry, or could we use some more?
Well, we could use a lot more. And I think in general, most people aren't paid to think critically. They're paid to follow, the company line, and they're paid to push a company's product. And really, critical thought can get you into trouble in the industry, and I think people shy away from it because, for the most part, if you've been in the business a long time and you've built up a career, you're probably doing really well, and you don't want to contaminate that.
Right. Yeah, and I think that's one of those things that a lot of people don't. I think it was Keynes who said it. Sometimes it's better to be conventionally wrong than it is to be unconventionally right. And I think that's sort of what I'm hearing you say. I don't want to put words in your mouth, but so that allows me then to turn the corner from independent thought to running an independent firm. So a lot of what you're doing at Design is trying to enshrine the idea of letting advisors do what they want and not being told this is what you will think. Can you expound on that, please?
Well, it's really interesting. Years ago, I was tasked with teaching a course to undergraduate students, and throughout the course, there were several different issues, and students were forced to think about each of the issues. And the issue changed every week, but they had to look at issues through a conservative lens, a liberal lens, and a radical lens. And when I say radical, it's very different from how you might think about politics. But if you can imagine conservatives being big companies, liberals being more warm to big government, the radical really isn't on the spectrum. In a radical perspective, when thinking about many issues, including investments, would be not thinking like a big bank or not thinking like the big government, right? So here you are, you're neither on the left or the right, you're really not even on the spectrum. So if you think about what's doing right and what's best for a client as an advisor, you should have the freedom, as long as you're following the rules, you should have the freedom to speak and think how you want. If that's how you feel, you can manage your practice and serve your clients, and that's the model that you need to operate. It's very difficult to find that. So there's a market space for a firm that offers that to advisors and portfolio managers.
One of the things that I know I've heard you say in the past is that your view is that independence is disappearing from the Canadian marketplace, and that a lot of firms are have advisors that are captive, and that as a result, there's a certain amount of groupthink, and this is the way we see things around here, and advisors are actually being, in many ways, actively dissuaded from thinking critically and from being independent. Where do you see this headed in the next, let's say, 6 or 8 years?
Well, independence is going away and it's actually accelerating in Canada. Unfortunately, most advisors and portfolio managers that work for a dealer don't really understand the metrics and the finances of what goes on behind the curtain. It is much more lucrative to be an asset manager than it is to be an investment dealer. However, if you are both, and you have some influence over what your advisors are selling or recommending to their clients, to me that's in some ways a conflict. And there's some companies that do it well and manage that conflict, but others are moving more towards becoming fund companies rather than dealers.
Mhm. So the phrase that the terminology that we use within the industry is being vertically integrated, where you both manufacture and distribute products at the same time. So you're not just the person who's giving the advice, but you're also a part of a company that manufactures the products. And again, to make sure that everyone following along at home understands, there's a lot more margin in being the product manufacturer than it is in being the person who's giving the advice and putting the portfolios together and doing the planning and helping people go through. When that happens, as we go further down the road, are we at the point where we, or might we get to the point in the not too distant future where independence as we have come to know it is perhaps gone altogether?
It's one of the only times you'll ever see me or hear me say that we need more regulation. And I mean, it's kind of ironic because I mean, I think that, for most of my life, I've felt like, we've needed less regulation, but I think the regulators are getting things right now. And they're moving towards what's best for the client. And what's best for the client is a regulated environment where, if you're sitting down at a kitchen table in front of, a family that, and you're trying to, give them advice on their financial future, you should have, a clear lens and not be influenced by any of your company's quotas or targets. I think that's becoming more rare, and I've been in this business 27 years, and I think it's only getting worse.
Right. One of the things that regulators have been bringing in the past couple of years is something called the client focused reform, CFR. And the new lens through which suitability is being measured is a dual focus lens with regard to risk tolerance and risk capacity. What's your take on regulating accounts and making sure accounts are suitable for end user clients uh, by looking at things through risk tolerance and risk capacity, as compared to maybe more of the old school way of doing things, of having this allocation in stocks and this allocation in bonds, and not deviating too much from that mix?
Yeah, I think it's an interesting question. I think that I mean I should really talk to my compliance colleagues before I answer this question. However, I think things are situational, and I see things going more and more towards scale and more automation when it comes to compliance. And I think things come down to the situation of the client, what's best for the client, and being able to manage the return and risk. And I think that really hasn't changed. And I think that if you do what's best for your client, I think that's that's the right answer.
So one of the things I've also heard you talk about in the past is that going forward, customization will be more important than scale. What do you mean by that?
Well, if you think about it, when I talk to our competition, they talk about return on investment, they talk about scale, and I think to myself, well, how is that any good for a client? And I mean, customization is a very expensive business model in the dealer world. Scale and automation is much more profitable. But I think to myself, if the dealer is more focused on profit than the client, I don't think that is in the best interest of what we're really all about. Like why you get into the business is so that you can, build up your expertise and help people. And I mean, you have clients that have problems that need solving, and if your dealer is focusing on returning investment to the external shareholders, I don't know how that's any good for the end client.
Okay, you were talking about building up expertise, and I wanted to do a small shift. One of the things that you've also mentioned to me in the past is that you've lamented the lack of a sort of unifying theory of financial planning. And there's a lot of research with regard to portfolio management and asset management, but with regard to financial planning in terms of what is truly the best way or the right way, not as much. I'm wondering if you perhaps have some thoughts as to how we can get to a more unified view of what financial planning ought to be and how we can actually use it tangibly for most clients.
I've given a lot of thought to this recently, and I think that the area of personal financial planning is probably 40 or 50 years away from having a theoretical base. I studied entrepreneurship, and that's where I focused my research and scholarly activity. And the field of entrepreneurship had the same problem 40 or 50 years ago. When you think about business schools, we think of finance, accounting, marketing, and human resources. But when it comes to something that is a relatively new, and I think financial planning, I think most of us would agree that it's been around for 40 or 50 years, recognized as a career or as a discipline. It really lacks theory. And some practitioners and maybe many practitioners will wonder what's the use of having a good theory. But if you can't prove something, then how are you able to say something? And I think that's why the area of personal financial planning has a long way to go. And before I was a practitioner, before I was an academic, and I felt that same way. I thought that academics sat around and drank expensive coffees and pontificated about theories, and until I started collecting my own data and running analytics. And I think that the what you'll find is if you don't have a platform or a theoretical base, I don't know how you can say things, because if you can't prove them, it lacks credibility versus some of the other areas within business schools.
One of the things I talk about in Bullshift is optimism bias. And I've said repeatedly that I'm an optimist, and I think most people are optimists, and optimism is mostly a good thing, and that it works out perfectly fine for most people 19 times out of 20. But every once in a while, my view is that optimism can bite you in the bum because you're not really as careful as you could be, because at some point optimism can give way to hubris and complacency. and the fragility of not being careful. What is your take on optimism?
What's interesting, I mean, one of the coolest books I read was it's called Happiness for People That Can't Stand Positive Thinking. And I mean, when you think about it, um, really you get paid to gather assets, and you get paid more when the assets are invested fully into equities. And I mean, there's definitely a bias. Um, you know, for the most part, I think um, there's a couple of different ways you can get into the investment management business. You can go through the finance training, but there's also a lot of sales, and you can't, if you want to manage a client base or a book of business, you have to be good at selling, and you have to be good at selling things that make you money, or make your dealer money. So for uh, somebody that's sitting across the table, if you get paid only 20% of your normal commission by going into a GIC, you're trying to find ways to think positive and make everyone think positive that things are going to be great in the long run.
Right. What about so from there we can go. The question I asked you a moment ago is about attitudes and about optimism. What about the actual technical training itself? Can you offer your thoughts, please, on what a typical advisor would learn in order for him or her to be an advisor, as opposed to what he or she might learn if they're just taking a course in finance in university without necessarily having an eye toward giving advice to mom and pop down the road, Mr. and Mrs. Jones?
Yeah, I mean, so I have a background as a CFP and also a CPA. Um, I thought that the road to becoming a CFP was quite difficult at the time. I also felt like the road to becoming a CPA was quite difficult at the time, but the road to becoming an investment advisor is not very difficult. And it lacks some of the, I would say, rigor that it might take to become a lawyer or a pharmacist or a dentist. And I think that going forward, that will continue to affect the profession. So when you're thinking about clients, who do they go as their trusted advisor? Would it be their lawyer, their banker, their accountant, or their financial advisor? I think that the financial advisor may struggle, because I think that many clients would think that it's not all that difficult to prove. I mean, the ability to get a registration and pass some courses is just not the same as going to law school. So I think that the profession in general has a long way to go. Although, having said that, there's some very skilled people in the business, but it's hard for the average person to know who has. I mean, a lawyer is a lawyer, right? And a doctor is a doctor, but when it comes down to financial advisors or people in the investment management world, it's still very complicated. I think some great things are being done, but a lot is needed still.
Yeah, my impression is that all the professions, law, medicine, accounting, have a lemons problem, where there are some practitioners but who are just not very good and aren't keeping up, and for whatever reason might not have a good bedside manner, or might not have a good demeanor about the way they do things. But if one were to look at the entire continuum of best to worst, it would seem to me that the range for the people giving financial advice is even wider than it is for the other professions, which is to say the good ones are really good, and the bad ones are maybe even more harmful than the bad doctors and bad lawyers. I don't know if you would share that view, but the sense I'm getting is I'm not trying to cast aspersions on the bad of anything, and I want to give props to the people that are good, but I think my point is there's a wide dispersion of competency and rigor in the financial advice channel that you probably don't get as much of a dispersion in the other professions. You can disagree if you want, but that's my viewpoint.
I mean, I agree. I mean, it's to become a lawyer, it's 7 or 8 years. To become a CPA, it's 6 or 7 years. To become a financial advisor, investment advisor, I mean, is relatively simple, compared to other professions. It's it, but it's not an issue being talked about, right? Like
Right.
it's not on the regulatory radar. and the dealers, as long as they're hiring people that can generate revenue for the business, and in general, if clients are happy, then all is good. But I think in general, in the long run, a lot is needed to be done for the investment advisory world to be able to, you know, compete against a lawyer or accountant in terms of the professional qualifications.
Great. Okay, so I want to wrap this up fairly quickly here. So I want to get to the way that I always end my discussions here with two sections. One is called That's Bullshit. And That's Bullshit is where I ask the person that I'm speaking to, in this case you, what is it that you think is wrong with the financial services industry? What is it that you think we could be doing better?
Well, I taught 10,000 undergraduate students,
Mm,
either investments or personal finance or some course related to the topic. And I think that behavioral finance is generally not taught in schools. Um, in 2000 and 2001, I essentially threw out all of the textbooks I was using teaching those types of courses because I don't think the models work. And if you've been through a 35-40% market crash, I would think to myself, preparing for a lecture, why am I showing them these formulas? They're working through these formulas and trying to quantify what an investment return is, but in the end, you're sitting in front of somebody and it's their life savings, and you have to protect that as much as you need to grow it. And I think that I started to focus more on the psychology of investing rather than hardcore finance. And I believe it to this day. My father was a big fan of Nick Murray 40 years ago. I was lucky enough to learn about him and his thesis. And I think that the world of investing is far more subjective and far more about people and emotions than econometrics and financial models.
It's funny you should say that because if you were to ask me why I wrote Bullshift, that would be almost verbatim the answer I would give. Is that everything that I was taught was about numbers and formulas, and it can all be if you just crunch the numbers hard. If you torture the data long enough, it'll confess to anything. And there's a lot of that. Just it's all about numbers. In fact, it's very little about numbers. It's very much about your aspirations, your life, your comfort level, the love you have for your family, and how to actually make that happen by making financial decisions and making them in a purposeful, clear-headed manner that allows you to focus on your objectives. So well said. So that then brings me to the second half, which is having said that's bullshit, and having said that the problem is we don't teach behavioral finance in school enough. The second thing is shift happens. If it was up to you, how would you address the problem that you just identified a moment ago? How would you get people to better understand behavioral finance? Where would you teach it? How would you teach it? How would you operationalize the concern that you and address the concern you raised a moment ago?
More people like you, John.
Is that all? Is it that easy?
No, it's actually not easy because when you think about it, business schools are driven by people in chairs paying tuition. And the big programs are accounting and finance. And in finance, there's 75 years of of smart people, scholars and practitioners that have learned essentially handed down knowledge of financial theory, existing financial theory. And I think maybe 15 or 20 years ago, I started to see more behavioral finance type, psychology, subjective like belief systems and ways of thinking. But it has a long way to go. And I think just more things like this, talking about it more, and having, unfortunately, black swan events in the marketplace where people make you think. And I myself invested a lot of money into Nortel, and here I am, a CPA and CIM and everything, and I studied for probably 20 hours the financials, and here I was, and I lost money, right? So how does that make any sense? If I look at the economic and financial theory, it doesn't. So I think that more and more we have to talk about what's really going on, and what's really going on can't be quantified and measured.
Right. Excellent. Okay, thank you so much, Michael. I really appreciate your taking the time. I know you're a busy guy. For the people that are listening and watching at home, please be sure to like and subscribe. We really appreciate your support. And Michael, I'm sure we'll be speaking again in the next little while. Thanks for taking the time. For the people who are listening in, Michael's halfway across the country attending a conference, and he decided to duck out of a session to be able to join us today. So it's really, I'm very thankful that you made the time to make it all work today.
Thanks, John. Really appreciate you having me. And I wish you well. Enjoy the weekend.
Thanks.
John DeGuy is a portfolio manager in Toronto and the author of the book Bullshift: How Optimism Bias Threatens Your Finances. Bullshift is available online and in bookstores everywhere. The opinions expressed in this podcast should not be construed as investment advice. Bullshift, the podcast, is produced by TalkShoe, a division of IOTM.